Hi everyone. So today is our fifth lesson for investment analysis. We've actually covered a lot of sections in this module. We've actually come to almost half of the module content. And today I will be covering the remaining area from investment analysis. Basically, what we did last week was financial market. We did kind of like a small introduction as to what financial market is. And at the end, I kind of explained to you that the financial market can be classified into two sections. And I said one is called money market, and thereafter the other one, I said this capital market. So today we will be looking into that. And as you can see, the first section that we will be covering is the first type of market, which is money market. So what is money market? Money market is basically a short-term market for the securities that mature in less than 1 year. So when it comes to money market, it's normally related to major banks or other financial institutions. And in this particular market, one of the main things that we should remember is it would trade all the securities which is short term actually. So short term, as you know, is those securities which mature in less than 1 year. So basically money market would be a market in which like the investors kind of sell and buy for security which is of short term. So one of the things when I say short term, it means that the maturity period is less than 1 year and it is traded in this particular type of market. So these some instruments that are traded in the money market are treasury bills, interbank loans, intercompany loans, commercial papers, repo, reverse repo, and municipal bonds. So under this market, all the securities which have a maturity period which is less than 1 year will be considered, and as you can see, it will be treasury bills which is less than 1 year, interbank loans which are less than 1 year, intercompany loans, etc. So moving on, we are going to talk about the instruments that are largely traded in the money market. I just explained few of them, but let me just kind of go through each. So first I said treasury bill. So treasury bill, so one of the principal features of this treasury bill is that the instrument is entertained at a market free rate and the issuer of the instrument would be the government. So treasury bills are generally issued by a government and it is entertained at a market risk free rate. And obviously, when it comes to money market, the maturity will be less than 1 year. Now, let's look at commercial paper. So what is commercial paper? These are basically loans, generally which matures in 9 months and traded at any time before the maturity date. And there will be short-term interbank loans, obviously within banks, loans which happens within banks, and short-term intercompany loans. When there are lots of companies in a particular group, there could be loans that happen within the different companies. So it is an intercompany loan. And certificates of deposit or the CDs, bills of exchange, commercial payments, and euro currency. All these will basically be ones which are less than 1 year. So now moving on, we are just going to talk about capital market or the security market. So a capital market is basically a long-term market consisting of security which will mature greater than 1 year. So what's the difference between the capital market and the money market? The money market will have securities which has a maturity less than 1 year, and capital market is the same type of security which will mature in security which will mature in greater than 1 year. That means, it would be something that would mature in like 2 years, 3 years, or any amount of years, which is more than 1. So some of the assets such as bonds, which have a fixed lifespan, whereas others such as common stock have a indefinite lifespan, will all be included in this capital market. So when it comes to capital market, now money market, because it's less than 1 year, it will be general, like a general market, you buy and you sell. However, when it comes to a capital market, because it has a longer maturity period, there are situations where investors would just buy and might have to sell it to another person if they are unable to stay till the maturity happens. So therefore, in a capital market, it will be composed of two types of market. One is the primary market and then the secondary market. So the capital market will be divided into two. One is the primary market. Thereafter, it will be the secondary market. So for basically, what is primary market? Primary market is the market in which issuer will issue their new bonds or securities, and the investors will buy from it. However, when it comes to secondary market, this is a situation where a person who has a security which has a higher, which has a higher, which basically has like higher rate, how do you call it, like a higher like maturity date, and the investor is unable to stay till it matures and wants some money and wants to kind of sell it off. The market that will be used here would be the security market. So a smoothly functioning security market would aid the primary market to improve its liquidity and lower the cost of capital of firms, and capital markets have two main functions. So basically, if a good secondary market is there, that would ensure that the primary market is functioning as well. And these two are kind of interdependent. So now let's look at the two main functions of a capital market. So what are these functions? So the first function is they will basically help the primary market to kind of raise new capital for profit-making entities. So usually this is basically in the form of like equity, or like it could be like equity which is new, or something related to existing shareholders. And also the second function would be they will basically allow the trading of existing securities inside kind of like the secondary market. And one of the important function is that it will provide liquidity for financial instruments. So after that, we are going to just talk about another type of market, which is the foreign exchange market. So now, what is the foreign exchange market? So a foreign exchange market, as you know, basically plays like a major role in exchange of one currency for another. So basically, when there is a global, due to globalization, obviously there's a lot of trade happening between countries. Then while the payment happens or any kind of transaction happens, obviously there should be kind of like an exchange of currencies. So this exchange of currencies basically happens in a foreign exchange market. So foreign exchange markets plays a major role in the exchange of one currency to another. And here there are two things that happen. It would be the spot rate and the market rate. They are kind of very important that are used for transaction when an exchange rate. I'm very sorry about that. So when it comes to transaction, spot rates are kind of used. So what happens is when an exchange rate, when a transaction is going to happen, the exchange rate which is applicable on that particular day will be used and agreed upon for a future kind of transaction, or it could even be agreed upon to pay the rate that is on that particular rate, because exchange rate keeps on changing day by day, hourly. It could kind of change. So therefore, in order to have some kind of management in the market, the spot rate or the forward rate will happen. So now trading will obviously, now as you can see, trading will happen on spot or even in forward delivery. And now let me kind of explain to you what spot contract is. Sorry about that. What spot contract is and what forward contract is. So when it comes to spot contract, this is like a binding obligation to kind of buy or sell a certain amount of foreign currency at a current market rate. So at a spot contract, what happens is when you're going to buy a particular certain amount of foreign currency, what happens is that particular, during that time, whatever foreign currency exchange rate which is applicable will be used. Okay, so that is a spot contract. But when it comes to forward contract, it is basically a binding obligation to buy and sell a certain amount of foreign currency at a pre-agreed rate of exchange on or before a certain date. So what happens is, and on a spot contract, you just, when you're going to kind of buy or sell a foreign currency, that particular time exchange rate will be applicable. In a forward contract, this particular currency difference will be pre-agreed within these people and exchanged before a certain kind of date. So which means it is a predetermined rate. Therefore, it will be very easy for organizations to move forward with their online transactions. So with that, so now we are going to talk about derivative market. So as you know, we talked about the main capital market, where we spoke about money market and how it can change. Then we spoke about foreign exchange market, and now we are going to talk about derivative market. So what is a derivative market? So derivative market can generally be used to kind of hedge external hedging instruments, such as, let's say, forwards, options, swaps, or futures. So this would kind of help to reduce the risk in foreign currency trading and also be used simply for the purpose of speculation. So basically, this particular derivative market would have hedging instruments, which are forward, options, swaps, and futures. So I think we spoke a little about some of these, and there will be some that we will be talking later on in this module. So the market in which all this will be traded is called the derivative market. So now we are going to talk about share price volatility. So what is stock price volatility? This is basically kind of like an indicator which is most often used by option trader to find the change in trends in a market. So stock price volatility is useful in order to understand the trend of the market. So for that, there are a few things that will be done. One is technical analysis. So now, what is technical analysis? This is basically like the analysis of the past movement in the price of the financial instrument, the currencies and commodities with a view of predict future price movement by applying an analytical model. So here, what technical analysis does this? It will look at the past movement of the price of this particular financial instrument or the currency, whatever. It depends on what we are going to do the technical analysis in which. So the past movement will be used and a future price will be predicted. So what is fundamental analysis? So fundamental analysis is like the assessment of external and internal influences, like on the operations of an entity with a view to assist in investment decisions or information which is accessed using fiscal or monetary policies, financial statements, industry trends, and competitor analysis. So basically, this will use the assessment of external or internal influences on operations with the use of investment decision. So then we'll be talking about random walk theory. So now what is random walk theory? This will basically stipulate the stock price changes and have like some kind of allotment and are independent of each other, and also use the past movement or trend or stock price or market cannot be used to predict the future movement. So one of the things that we need to understand is in this, it will stipulate the stock price changes that have some allotment, and they are generally independent of each other. Therefore, I mean, the past movement or trade generally cannot be used to predict this future movement using this kind of theory. So we were talking about the three theories: technical analysis, fundamental analysis, and random walk theory. Now we'll be talking a little about yield-basis securities. So basically, here we are just gonna talk about generally what these terms mean. The price of a financial instrument. What is the price of a financial instrument? It's basically the present value of the future cash flows, and the future cash flows of a debenture can generally be coupons or capital redemption, and the discounting cost of capital for calculating the price of bonds would generally reflect the risk of the instrument. Now we'll be talking about yield to maturity or YTM. So this is basically the total return for investing in a bond, and generally known as a redemption yield. So it could be calculated based on IRR of an investment. So yield to maturity would basically be IRR, which we'll be talking about. Okay, now what is deep discount bonds? So this discount bond is kind of issued at a significant discount at par value, and discounted bonds contain capital gains and the coupon value. So zero coupon bonds. Zero coupon bond is the extreme of deep discount bond when no coupon is offered, no coupon is offered, and in order to compensate for the lack of the coupon, it would generally offer higher capital gain, implying as even a lower issue price. Now, what is a hybrid instrument? It would basically have the debt and equity, and in a preference shares, it would have features such as debt and equity, because there are preference shares which would have guaranteed return, or there will be redeemable preference shares which are similar to redeemable debt, and there will be like preference shares which is like would have something which is upon perpetuity as well. So some of the equity features of a preference share, there would be preference shares which is paid only if the company has profits and reserves, And there'll be ones which is irredeemable preference shares, which is basically similar to equity. And convertible bonds, it would make a person decide on whether to convert the bond shares or to have it kind of redeemed. And the conversion and the redemption of a convertible bond would differ. So, so the rationale behind it that the share price appreciation, which could still be would be like very attractive to the investor. And when it comes to convertible bond, actually debenture could be kind of redeemed to be converted to a number of ordinary shares at the same company at the choice of the investor, known as conversion ratio. So conversion ratio would be specified at the time of issue. Okay, conversion value will be specified at the time of issue, and a conversion premium will also be there. So based on the number of ordinary shares which is decided as N, the company will be the investor will be able to convert the bond into ordinary share. So warrant is issued with shares or debentures. It's kind of like a sweetener to kind of encourage investors to participate in an issue, and warrant holder will basically be able to buy a share at an agreed price with a agreed future date. So the warrant will just basically be exercised depending on the share price and the exercise date as well. So moving on, we are going to talk a little bit about risk. And now see what is a risk? Basically, a risk is kind of like a volatility around any type of expected outcome. So basically, when it comes to risk, these are kind of measured using a method called standard deviation. So basically, obviously, you know, risk would have caused a lot of difficulties for the management when planning, forecasting, and budgeting. This we spoke about initially, right? The initial two sessions. And with regard to like international investment risk and rewards of each investment should be compared to identify the compared to identify the net resulting benefits as well. So main forms of risk generally faced by institutions are the currency risk, liquidity risk, credit risk, interest rate risk, inflation risk, credit rating risk, financial reporting risk. So different kinds of risk that would be faced by organizations. So now we are going to move on to talk about the main factors to be considered when these risks are internationally. So done. So basically the resulting level of international competition and dynamism will be considered. The language barriers will be considered. Political risk and associated legislative will be considered. Social and cultural barriers will be considered. Fluctuations of international economic variables will be considered. Accessibility to local technical expertise, demographic inequalities, rivalry in the local market, company fundamentals, all these will be considered. So currency risk is basically risk associated with international investment, and currency risk will have three main forms. What would be transaction risk, translation risk, then economic risk. Okay, now, you know, I was just saying transaction, translation, economic risk. Now you'll wonder, what is it? So what is transaction risk? This is kind of like the risk which will arise from like a transaction which has already been occurred, but it is not settled. So from the date of transaction up to the date of settlement, there could be currency fluctuation, which will affect the expected results, right? So in these kind of risk associated will be called as transaction risk. Sorry. Now we will be moving on to translation risk. So what is translation risk? This is when converting result from one currency to another for reporting purposes. This will be used, and this would be due to the value of the income, expense, and assets, which would change depending on the exchange rate. When you don't kind of buy it at the particular time and decide upon buying it at a later date, obviously there'll be an exchange rate difference, which will be the translation rate. Now moving on, let's look at economic risk. So what is economic risk? This is basically the possibility of a company's future cash flows affected from the fluctuation of the exchange rate. So when it comes to pure domestic company, which is affected by economic risk due to like the implication of currency risk on company's operation, this will be used. So when it comes to economic risk, is it explicit? No. The management would kind of find it difficult to identify the economic risk, and it could basically be the most significant currency kind of risk. Okay, so the other type of risk would be the political risk. So what is a political risk? This is basically the company making international investment has to kind of look into the political risk, because the politics that particular country will be like something that needs to be considered, because there's a lot of risk involved based on the taxation and the legislations in the company. So the main political factors that are kind of used would be the asset expropriation, so which would have instances where the foreign governments may not nationalize the operations of MNC, and it could cause expropriation of assets elsewhere. Then the second one would be profit repatriation. So what is profit repatriation? This would basically be like when the government kind of restrict the remittance of profits as dividends to the parent company. This is called a profit repatriation. So moving on, we are going to talk about ownership restriction. What is this? Now, when it comes to political risk, there could be like restrictions for ownership of companies to meet certain regulations. Like ownership may need to be diluted, like as an example, now Coca-Cola in India faced kind of this situation in the 1970s. Actually, this is a small example for it. And then there is taxation changes. So when it comes to taxation, say, time to time, the tax rates can kind of change and new rates can be introduced, which will affect a company which is operating in another country. So this factor will significantly impact on the international investment appraisal, and this basically needs to be considered as well. So now we will be kind of talking about the portfolio management, which is one, which would be actually one of those important sections in this particular lesson that I prepared. So this would basically be our last topic for the day, and last from this lesson as well. So now let's see what portfolio management is. Now, what is portfolio management? So if you can see, a portfolio is basically like a group of financial assets. It could be like stocks, it could be cash equivalent, it could be a bond or a security. And it could also be the funding counterparts, obviously, which would be things like closed funds or exchange traded, where it would be that group of things. So it would basically mean different types of debt would kind of be included, not just debts, actually debts and assets will be grouped according to what is similar. So basically portfolios are generally held directly by the investors or managed by the financial professionals. And here, like the prudence will be suggested that the investor should construct an investment portfolio in accordance with the risk tolerance and investing objectives as well. So here, one of the accounting principle that will be used would be, sorry, that will be used will be the prudence concept. Also moving on, portfolio investment can basically be a wide range of assets, which could be different asset class, as I told. It could be stocks, it could be government bonds, and it could be treasury bill, real estate, investment trusts, could be corporate bonds, it could be exchange traded funds, which is ETFs. So the real estate investment trusts are all called REITs. These are ETFs. So also like mutual funds and certificates of deposits, all these things will be included in a portfolio. And in portfolio investment generally includes options, derivatives, warrants, and futures. And also issue. I'm very sorry about that. So it would also, as I told, so derivative will, this would include things such as options, the derivative, and also include things such as warrants or even futures. So when it comes to physical investments, which are like commodities, real estate, lands, and even timber, these things will be kind of used in a portfolio as well. So you need to understand portfolio is not something that can be defined and said, okay, these are the things that are included here, because it includes all sorts of financial instruments and like equity or debt related instruments as well. So now moving on, now we just kind of try to understand what portfolio management is. So as you can see, this is basically grouping or managing the different types of financial assets that the organization has. Sorry. So this is when any organization has different types of asset, these will be kind of categorized based on what type, what types of cash inflow will come in and what type of instrument that is. So this regrouping is basically what portfolio management is. So after regrouping, it will be very easy for any organization or even the management to kind of choose upon what they are going to do with all these financial assets. And while taking decisions, these things will be very important for an organization, because proper portfolio management ensures that the financial assets of the organization are properly invested upon, and that all these the different financial assets are kind of managed really efficiently and effectively. So as you obviously saw that there are lots of different types of financial assets which would be kind of managed in a portfolio here. So while we're talking about portfolio management, there is also something else which we need to talk about. Now, we spoke about CAPM, right? We spoke about CAPM and explained to you what that means, right? Now here we are going to talk about arbitrage pricing theory. It is also a theory which is basically an asset pricing model based on the idea that the asset return can be predicted using the relationship between the asset and many common risk factors. So arbitrage pricing theory also is similar to CAPM. So CAPM is a different kind of theory, and arbitrage pricing theory will be different as well. And as you can see, this will be based upon the assets pricing model, based on the idea when the assets will be returned or predicted using the relationship between the asset as well as the common risk factor. So he created so this was basically created in 1976 by a person called Stephen Ross. So basically Stephen Ross is the person who created this arbitrage pricing theory. So therefore it's kind of something that is new. It's not something that came in from long time ago. And basically this theory, what it does is it kind of predicts the relationship between the returns of a portfolio and the returns of single asset through a linear combination of many independent microeconomic variables. So here, basically, when it comes to arbitrage pricing theory, one thing that we need to remember is that in this particular theory, the organization will be kind of moving into a linear regression model, where a linear combination of different types of macroeconomical variables will be considered. And here, the main thing that it will predict would be the relationship between the returns of a portfolio as well as the returns of a single asset. So that is what arbitrary pricing theory is. Now let's move on to the functions of the portfolio management. So I was just kind of talking to you about portfolio management, what it basically means. So let me talk more about portfolio management, where I'm going to tell you about the functions of the portfolio management. So now, what are the functions of portfolio management? So as you can see, in order to identify the investment strategy and to select the best mix of investment, a portfolio management is needed, because similar kind of securities will be put into a certain section. Therefore, the actions related to that particular set of securities will be similar. So it will be actually easy for an organization, because if an organization tries to look into all their investment one by one, it will be quite such a cumbersome work, because they'll have to really, I mean, if it's a large organization, imagine the number of investments that are included. And if they have to check into, one by one, it will be something that is very difficult, and something in which like that a lot of time will be spent upon. That's why the portfolio management is very important for any organization, because when there is a certain when deciding upon doing some kind of investment strategy, the best mix of investment will be kind of used. Thereafter, hedging against inflation in order to optimize the return. So when it one of the things that the functions of portfolio management does is it will try to hedge against the inflation in order to kind of optimize the return. So portfolio management ensures that hedging is done. Thereafter, one of the functions of portfolio management will be to make a timely decisions on buying and selling securities. While buying or even selling securities, the organization needs to understand, how many similar securities there are, how much do I get in each, so which security class is suitable Sorry about that. Which type of security is suitable in order to make timely decisions when it comes to buying and selling of different types of securities. And also, now moving on, like we need to understand that there are many functions, and one, hold on, something happened. Sorry, let us move on to, yes, now we were talking about the functions of portfolio management in order to understand why we need to have a portfolio management. So we talked about the first three, where we say that selection of best mix of investment is there when it's when an investment strategy is decided upon. Thereafter, the second function would be to hedge against the inflation. And so portfolio management would do that. And the third function would be to make like a timely decision when it comes to buying and selling securities. So now we will move on to the fourth function of portfolio management. So as you can see, the fourth function is to maximize the after-tax return by kind of investing part of the portfolio in tax savings or investments. So in order to maximize the after-tax tax return, what happens is the investment actually happens of the portfolio, and which will kind of contribute towards the tax savings in a particular investment. So those are the functions of portfolio management, and I hope that you got a better understanding of portfolio management, and you could like read upon this section to understand the concept better. Now, with that, we need to also understand that portfolio management can be an active kind of portfolio management, and it could even be a passive portfolio management. So now, what is this different? Why do you say there is an active portfolio management and a passive portfolio management? So looking at this, I've just prepared this particular table. Looking at it, we will be able to identify the difference between these two, so that we know what exactly, why do we have two types of portfolio management. So now let's look at the active portfolio management. It is basically says that buy and sell stock in an attempt to outperform a specific index. That happens in active portfolio management. However, in passive portfolio management, what happens is it will involve the formation of a portfolio allocation that is the same as a specific index. Okay, so thereafter we'll be kind of moving towards the next section or next point actually. So there will be a close attention that is paid upon on market trends and shifts in the economical and political environment. So in active portfolio management, this will be done. However, when it comes to passive portfolio management, the managers will select stock and other securities which are listed on an index and applies the same weighting. So therefore, as you can see, the active portfolio management as well as passive portfolio management is very different. So thereafter, we'll be talking about the information which is used to time the purchase or sale of investment in an effort to make advantages of irregularities. So when it comes to active portfolio management, this is basically used in order to time the purchase, or let's say the sale of investment, like in an effort to kind of find the advantages of irregularities. However, when it comes to passive portfolio management, The purpose of passive portfolio management would be is to generate a return that is kind of same as the chosen index instead of outperforming that. So we'll be talking about the last difference, which is the fourth difference of active and passive portfolio management. And as you can see, in an active portfolio management, the management fees assessed on active portfolios are higher than the passive portfolios, obviously. And when it comes to passive portfolio management, the investment strategy is generally not proactive and the management fee is generally lower. So as you can see, sorry. So as you can see, we have come to actually the last part of this particular lesson. And as you know, I have just included a few references that we could kind of look into. As you can see, hold on, yes. So there is this investment analysis and portfolio management, which is there is a book, and also the online terms and understanding of it is included as well. Hold on. Okay. And thereafter, things like obviously arbitrage pricing theory, what does that mean, those things, and how to calculate or even managing risk are kind of included here. And it's not necessary for you to go through these references. However, I hope that you try to kind of, learn by reading books related to, and to try and understand what is exactly expected from all of you. And as you can see, this is the last slide. So yes, I just hope all of you have a happy studying. However, before all that, I'm going to do my normal recap where I'll be just talking to you what we did. So let me do this normal recap of the first, the full assignment. So when it comes to the topics, as you know, we were talking about the concept of investment, where we spoke about what investment is and the basic objectives and the motive of investment, and talked about investment cycle, and we spoke about it a lot. And then the steps were talked upon. Thereafter, we spoke about post-completion audit, and thereafter how to link the investment, which is the ISIT. Thereafter, we spoke about market efficiency. I told about what efficient market hypothesis is. And then we went on to financial market and types of market. That is what we covered today. So basically, actually this, we covered it last week, this particular slide. However, the continuation happened today. So as you can see, we spoke about market, the finance market, and then the good characteristics of a good financial market was spoken. And thereafter, I explained to you that I'll be talking about two sections in the financial market, which is money market and capital market. So what happened is, today I spoke about money market and explained how any security which is having a short-term short-term maturity date will be considered. Thereafter, we spoke about different instruments that are used in the money market, and then moved on to the capital market or security market. And then we also spoke about the primary, secondary market, and how the two functions related to capital market as well. Then we spoke about foreign exchange market, what it is. We spoke about derivative market, and then spoke about the share price volatility, where we spoke about technical analysis, the fundamental analysis, and random walk theory. Then we moved on to yield-based securities, where we just kind of gave kind of like a small understanding of different I'm sorry, different types of section related to these yield-based securities, and thereafter we spoke about risk, different types of risk, and how the main factors related to risk. Thereafter we spoke about three main risk: transaction, translation, and economic risk. Then we spoke about political risk as well. Thereafter, we spoke about portfolio management, what it is, and about arbitrage pricing theory. And then we spoke about the functions of portfolio management. And thereafter, we finally kind of summarized using the active portfolio management and passive portfolio management, where we tried our best to kind of give you a summary of both and how it would differ each as well. So today now we have come to the end of this particular lesson, and we'll be starting off a new section of investment analysis, and I hope all of you got a better understanding about this module. And I just have thank you everyone for being with us, for listening to this recording, and I do hope that you have a good day. Thank you everyone. Bye.